Hey everybody, Smart Silver Stacker here. Welcome to another live stream. I hope you're all doing well. Do me a favor, if you can hear me loud and clear, put a 1 in the chat. And today we're going to be talking about the gold price and the silver price, why they're coming under some pressure right now, because they are. We're going to talk about the factors that are driving that. And once we get into those factors and lay them bare, I think that you will understand why, as a silver stacker, I'm not concerned about this pullback at all. In fact, I'm actually kind of happy about it. We're going to talk about why. So first of all, let's just take a look at the chart of silver here, courtesy of TradingView. You can see it's coming under some pressure down to about 2250. Still, from a technical standpoint, this chart's looking pretty strong, if you ask me. Same story in gold, still hanging tough above 2,000 bucks, just barely though, down to $2,006. Also, if you zoom this one out, still a very nice cup and handle formation forming here on the long-term chart of gold. And from a technical standpoint, all looks good. But what is driving the price of gold and silver down? Well, we know that it's also in the physical market, because just look at SD Bullion here. They're selling U.S. Silver Eagles now for $3.99 over spot. It's $26.72 for an ASE. So this is not just in paper markets. This is also occurring in the physical market. We're seeing premiums come down. Now, if you ask me, spot price comes down, premiums come down. It's a pretty good time to stack. But, feel free to let me know what you think about that in the chat or in the comments if you're catching this later. Let's get into the first story, which reveals why the price of commodities is coming under pressure. So first one, we're going to go through these fairly quickly. China's GDP expands 5.2% in Q4, misses market forecasts. We got the Chinese Q4 GDP data. The economy there not growing as fast as analysts anticipated. So the world's biggest hub of manufacturing, one of the biggest economies, slowing down. That's putting a lot of pressure on crude oil. You can see it was down significantly earlier in the session. It was down to around under $71. Catching a bit of a bid now, though, because you got to keep in mind there's these contrary forces at work in the petroleum market, in the oil market. And this is all related to gold and silver as well. I mean, all commodities are related in some way, shape, or form. And by the way, it's not just precious metals, not just gold and silver, not just crude oil that are under pressure today. You can see here on the Yahoo Finance page, you got all the major stock indexes coming under pressure as well. And I think the reason crude may be, doing a little bit better than some of these other assets at the moment, it's had a bit of a recovery from its lows because of the constant escalations occurring in the Middle East. We got this headline here from CNBC: unprovoked violation. Iran strikes Syria, Iraq, and Pakistan as Middle East tensions spike. Now, we talked about this in yesterday's live stream, but you can see how this is being portrayed now by the mainstream media. It seems to me we're being conditioned for a war here. So this is kind of helping to balance out some of the downward pressure on crude oil. But now, really, I think what's contributing more to the gold and silver price falling is this. This is the CME FedWatch tool, which reveals that markets are now anticipating a lower probability of rate cuts coming in March at the March FOMC meeting. This number where you see over here on the right, the 525 to 550 basis point expectation, that's where rates are right now. 42.9% of market participants pricing in a 42.9% chance of rates staying the same. Whereas, as that goes up, the probabilities of a rate cut declines. I think in December, this number got as low as, it was under 20%, the expectation that the rate would stay the same. So why are investors believing more and more that rate cuts are less on the table perhaps than they were previously? Well, we've got this guy, Fed Governor Christopher Waller, saying on Tuesday that he believes the Fed will be able to lower interest rates this year as long as inflation doesn't rebound or stay elevated. And we did just get a uptick in inflation data from December. Keep that in mind. But here's the important part that's really weighing on markets, this Fed governor jawboning things. He cautioned that the timing and actual number of cuts would depend on the data. Here's his quote: with economic activity and labor markets in good shape and inflation coming down gradually to 2%, I see no reason to move as quickly or cut as rapidly as in the past. So, I mean, this is just words coming out of the mouth of a Fed official. And we know lately they've been kind of bipolar on this topic. I mean, you've got Powell telling us that rate cuts were more or less guaranteed in 2024. Now, these other Fed officials being walked out here trying to kind of rein in the expectations of that. But ultimately, this is going to have very little to do with the price of silver because more cuts are guaranteed. More cuts will be necessary. We're going to talk about why in just a moment. But today, so that was yesterday. Today, we've got Christine Lagarde over at the European Central Bank contributing to this notion that cuts will not be forthcoming. She said the worldwide sell-off, or I'm sorry, this is a report from the FT saying the worldwide sell-off in stocks and assets came after European Central Bank President Christine Lagarde signaled that borrowing costs would come down in summer rather than spring. It also followed the first rise in UK inflation in 10 months. So UK inflation doing the same thing what we're seeing here in the US, beginning to tick back up. And Lagarde said this. Now, this is really critical. She said that market expectations for an ECB rate cut this spring were not helping the fight against inflation. And this really reveals the mindset of these political elites, these central bankers, that it's not their manipulation of the economy, it's not their economic machinations trying to set just the right interest rate for just the right amount of time and not letting markets do the work that markets do best. It's not that. That's not what's causing the inflation, what's causing these economic imbalances. No, it's market expectations of rate cuts. You know, it's always your fault, not theirs. This is what these central bankers believe. They believe that they can eliminate the threat of inflation simply by jawboning the markets, just like Waller did and like Christine Lagarde did today. Their goal here, I think, is to kind of have their cake and eat it too. They know they're going to have to cut, but they want to convince markets that they're going to maintain, steadfastness in their inflation fight, and they can't do both. And inflation is, I believe, going to run out of control. That's why I'm not really worried about a couple of central bankers driving the price of silver and gold down temporarily. I'll gladly buy into that drop myself. It's not financial advice, but I'm just telling you how I think about these things. And here's the other story that I think is a big contributor to why we're seeing the anticipation or the probability of rate cuts coming in March declining, and that is that we got a retail sales report for December here in the U.S. rising 0.6%. That's against expectations of a rise of 0.4%. Now, the fact that consumers are spending more, I mean, seems to me like the interpretation here by markets is that, well, this means that consumers are strong, that the economy doesn't need lower rates, but all this really means is that inflation is higher than we're being told. And of course, retail sales are going to rise if the cost of everything is moving higher. This doesn't mean that consumers are able to buy more stuff. It just means that they're paying more for the stuff that they're buying. And how are they doing that? Well, we know that they're running up their credit cards. We've got credit card balances now. January 3rd is the most recent data, $1.029 trillion. So, the fact that consumers are going up to their eyeballs in high interest rate consumer credit card debt to pay for their groceries and to pay for their essentials, I don't think that's a sign of a strong economy. I think it's a sign of a consumer that is at the end of their rope, and we are likely nearing a significant economic crisis as a result of all this debt that's in the system. And it's not just consumers. Here's the most recent monthly Treasury statement from the Department of the Treasury for December. You can see here from this chart, total outlays for the first quarter of fiscal year 2024. This is starting in October, so October, November, December, $1.618 billion. Total receipts, $1.108. That leads to a total deficit of $510 billion, now stacked on top of the already gargantuan and growing U.S. national debt. So you tell me, will the Fed have to cut? Will they have to monetize this debt? Or is the economy just running really strong and the consumer is strong? No, all that's going on here is that some Fed governors and Christine Lagarde are trying to jawbone the market lower to give the Fed a little bit of breathing room before they are inevitably forced to cut. But listen, when the real cover comes, and I don't know what that's going to be, whether it be a crisis in the banking sector, whether it be a crisis of geopolitical nature brought on by this conflict that is rising in the Middle East, there's going to be an event which will force the Federal Reserve to begin printing again, to cut rates, probably far more than what we've been led to believe by the Fed dot plot. And you know this stuff changes from month to month. Now, we've got the folks over at JP Morgan we covered in a recent live stream talking about how the Fed may have to bring about an end to quantitative tightening as early as the FOMC meeting at the end of January. So I suspect that, this jawboning is, now, of course, this is just speculation. I mean, I don't have a crystal ball. I don't know what's going on in the mind of these central bankers. But I think that based on what we've seen from them, this kind of back and forth messaging, it's very possible that we may get a somewhat more dovish Jerome Powell. I mean, he'll probably try to shroud what he's saying in a veil of ambiguity, but I think we're going to get some dovishness out of him in regards to the Fed's program of quantitative tightening, which, if you recall, at the last FOMC meeting, he said they weren't even thinking about ending or diminishing. But now we may hear about that, according to JP Morgan, from a note they published earlier this week. And also, I think any decline in the price of the precious metals that we see as a result of just a Fed official opening their mouth is a decline that I'll be buying into. Let me know what you think in the comments down below, because, nothing has fundamentally changed here just because Waller and Lagarde decided to wax a bit hawkish, and yet we're getting an opportunity to buy lower. So that's it for today's video. That's why the silver price is coming under pressure. Nothing fundamentally has changed, and yet we're being given a huge opportunity here for what is and continues to be the world's most undervalued commodity, silver. And gold perhaps coming in a close second there. So anyway, stay safe and happy stacking, everybody. I will catch you next time. Smart Silver Stacker out.